are literally shaping the planet.
Purpose is the only pathway to a regenerative future.
We have a choice to stay with the status quo or to change.
What is the point of trying to be just resilient when we can actually innovate?
The title sounded a lot more exciting. This presentation is generally more about kind of an overview about equity compensation generally. Some of it gets into the nitty-gritty about how different types of equity are taxed, as well as some of the more commercial things like what's vesting, when does it vest, what happens on an exit. So this is really intended to be kind of a comprehensive overview of equity. But I also want and I want people to feel free to ask questions. I'm assuming our questions we collate them and then ask them at the end. But save up your questions. I'm happy to do some Q&A at the end too about equity. And look, I'm already getting out ahead of my skis. So, this is kind of generally what this is intended to discuss, just a general introduction, an overview about what we see in terms of different types of vesting, different types of awards. So let's not talk just stock options. Let's talk about restricted stock, RSUs, profits interest. We'll get into the different taxation of awards. And this is when I start to lose some interest in the discussion. We'll talk about other few tax and securities law considerations because I am an attorney, so I have to warn you about some of those places where some companies can start to get into trouble. And then we can talk about a few M&A considerations as well. So just an overview. What is equity comp? It's a form of employee comp representing an ownership interest of the employer. It's linked to the value of the company's stock. Occasionally, you see it settled in cash rather than shares, but most of the time, people want the stock. People want the equity. The examples, stock, so founder stock in a company, stock options, and then, as I said, there are several different other types of equity compensation vehicles. So this is just I like playing with graphics. So this is just kind of a way to illustrate how equity compensation can be a really useful way to both motivate your employees. It's useful for startup companies to compensate their employees, especially startup companies that are cash poor, are in sort of cash conservation mode. This can be a way to provide some additional value to employees without depleting your cash. And then it's a way to make sure that the employee's interest in driving the long-term value of the company is also aligned with the stockholders, so your VC investors. This is a way of making sure everybody's interests are aligned in building the value of the company. So just as a high level, I'm probably going to focus more on the equity compensation that are offered by corporations. The entity choice can impact certain availability for different types of equity compensation. For companies that are organized as LLCs, which are limited liability companies, a lot of times, especially startup companies, like to organize as LLCs because they're simple, they're pass-through tax, they have a lot of governance flexibility. If you do have an LLC, there is a type of equity vehicle called a profits interest, which is very, very tax efficient. But employees don't always appreciate what a profits interest is, and it can have some other administrative and operational kind of issues with having a profits interest. As opposed to if you have a corporation, you're going to have the more traditional menu of equity incentive. Everybody knows what a corporation is. Everybody knows what stock options are. I think we call it a well-worn path. The profits interest route isn't available for a corporation. That's only available for an LLC that's taxed as a partnership. And so if you want any tax efficient compensation, it would require actually purchasing shares, which is not a huge deal for a brand new startup company at a low value, but can become cost prohibitive down the line. So in terms of equity structure and pool size, most companies, once you get past sort of the founder stock stage, will put in place an equity plan. So that's a formal equity plan that they can grant different types of awards. And it contains all the terms and conditions of all the grants. And you'll usually reserve a pool of shares for earmarked to make those grants. It'll have rules for recycling. So if somebody leaves the company and they forfeit some shares, those shares will go back into the pool to be used for grants to new employees. And then there are individual award agreements to govern the terms of the grant, you know, the number of shares, exercise price, vesting terms, etc. In terms of pool size, the practice varies widely. There's no sort of rule of thumb. I think I asked around a little bit, and so, you know, a typical tech company might have an equity pool about 15 to 20%, but it does, excuse me, it does vary across the different industries, sorry. And so it can vary depending on the founder stake, how many founders you have. And the pool size is also a point of negotiation when you get new investors. So new investor come in, it will be a negotiating point among the new investor and the company's founders in terms of the pool size and what's needed to incentivize and motivate new employees going forward. In terms of vesting, vesting is just what do you need to do to be able to earn and keep your equity. So you sometimes, I think of them as kind of two different buckets. There's time-based vesting and there's performance-based vesting. Most of what we see and most of what people get granted is time-based vesting. That simply means you just have to keep working at the company in order to earn the equity. In terms of the schedule, you know, it can vest all at once, so-called cliff vesting. It can vest over time in different tranches. It's called graded vesting. And I think I put the most common vesting schedule I see is a 4-year vest. You have a 1-year cliff, and then it's either monthly or quarterly thereafter. But time-based vesting can vary. I would say 4 years is what I most frequently see, but I do see some that are 3 years. I see some that are 5 years. And the good news about vesting is it's very flexible, and so you can kind of choose whatever schedule you want. Companies can also provide for performance-based vesting, which means that to earn the equity, they don't necessarily have to keep, well, they do have to keep working, but it's through a specific performance event, like a milestone event, or some sort of performance condition like EBITDA or revenue. I find this less common in the VC space, but it certainly is an alternative. And performance vesting can get pretty creative. There's sort of no limit on the type of performance conditions that you can use to create as a vesting event. So a lot of times people also are interested in vesting acceleration. So are there events where I don't have to keep working the full 4 years to earn my equity? Those events are typically going to be centered around like a termination of employment. And it's not going to be a termination for any old reason. It's going to have to usually be a termination without cause, sometimes a resignation for good reason, death or disability. I don't see that as common in terms of when equity accelerates. What I more typically see is, and more what people want, is equity acceleration around some sort of change of control event. And so you'll sometimes hear bandied about terms like single trigger or double trigger. What that means is a single trigger means that there's acceleration triggered solely by the change of control. A double trigger means that there's acceleration that's triggered by 2 different triggers. One is the change of control, and the second trigger is there also needs to be a termination of employment. If I had to give you numbers, I would say, you know, most of the acceleration, the vast majority of acceleration I see is in the nature of double trigger acceleration, where there has to be both a change of control and a termination of employment in order for there to be any acceleration. This one is also interesting. Sometimes vesting is added. So where I see this is in the context of a financing. You might have a founder who either has fully vested stock or a founder who is mostly vested, As a condition to coming in, an investor may, the investor might impose additional vesting on what is already earned stock. So that's very common to come in and impose new vesting. We also see this in the context of an M&A transaction. This is becoming more prevalent, is that they will actually impose vesting on either some shares that are rolling over, or they might even subject some of the deal consideration to vesting additional employment following a transaction. So there's a bunch of different types of, as I mentioned before, there's the standard plain vanilla options, but there's actually quite a menu of different types of equity incentive awards. We use, in terms of terminology, sometimes you'll hear people talk about full value awards versus appreciation awards. A full value award is equity comp that has immediate value and continues to have value even if the stock price declines. So those full value awards are going to be things like restricted stock, RSUs, or phantom stock. They get their value from the value of the underlying share, as opposed to, and in contrast to, an appreciation award. So an appreciation award only has value if the company's stock price increases above the exercise or purchase price. So those are things like stock options or profits interest. So for example, you get a stock option at the time the stock is worth $1, because you have to pay $1 to exercise the stock option. It's not worth anything to you until the stock price rises above $1. And if the stock price drops below $1, it has zero value. As opposed if you get a share of stock, it's always going to be worth whatever the underlying stock is worth. It only loses value if your company totally loses value. So stock options, and I apologize, some of this is very basic information, but sometimes it's helpful to go back to basics. Stock options is probably the most common type of equity. It is a contractual right to buy stock, to buy a specific number of shares in the future at a fixed purchase price. Sometimes it's called an exercise price or strike price. It's all the same thing. It is the price at which you can purchase the shares. For various tax reasons, the options generally need to have an exercise price that is no less than fair market value upon the date of grant. When an optionee exercises the option, they're actually purchasing the stock, and then they own the stock, the shares of stock that they purchased. They are usually exercisable anytime after vesting up until the expiration date. Here's with a caveat that some options are designed to be exercised early into restricted stock. Options will have a term of 10 years. When you hear the word spread related to an option, that means just the difference between the exercise price and the value of the company's stock. And then there's two types of options depending on, and it relates to the tax treatment of the option. There is something called incentive stock options, called ISOs, or non-qualified stock options, which some people say NQOs, some people say NSOs, some people say NQSOs. They're all the same thing. It just basically means an option that's not an incentive stock option. And generally when somebody leaves a company, their unvested options will be forfeited because they didn't earn those. And then most typically options have there's a requirement to exercise them within a limited post-termination exercise period. The most common is 90 days, 3 months, sometimes longer in the case of death or disability. And then if somebody is terminated for cause, typically they don't have any opportunity to exercise and the option would be forfeited in full. So now I'm getting into the super boring part as I start talking about taxation. So incentive stock options, ISOs, in order to be an ISO, it has to meet certain statutory requirements. So first of all, they're only available to employees. So non-employee directors or consultants cannot get ISOs. And they have to be on stock of a corporation. So this wouldn't be available, for example, in an LLC. They have to have a maximum 10-year term, although it's only a 5-year term if somebody is already a 10% stockholder. A maximum of no more than $100,000 can first become exercisable per calendar year. And this is determined by multiplying basically the exercise price by the number of shares. And just a word of warning, some amendments or modifications to incentive stock options can disqualify them. So anytime you have an outstanding ISO and you want to make a change to it, you should check with your counsel to make sure that you aren't accidentally disqualifying it from being treated as an ISO. And so I said, anything that's not an ISO is just going to be a non-qualified stock option. So even if you try to qualify something as an ISO, if it doesn't meet the requirements, for example, it exceeds the $100,000, it will be treated like a non-qualified stock option for tax purposes. As I mentioned, business entities other than corporations can't grant non-quals, so things like an LLC couldn't grant a non-qualified stock options. But this one is very broadly used because it can be granted to directors and non-employee consultants. And some non-qualified stock options have something called an early exercise feature. Some people used to call them California style. I don't really hear that so much anymore. It just means that it can be exercised before it's vested, and it can be exercised into restricted stock. So this is a good segue for restricted stock. So restricted stock is a grant, or it can be a purchase of stock that is subject to a risk of forfeiture, meaning it's subject to vesting. It's restricted in sort of two ways. One, it can't be transferred. You can't transfer unvested shares. And second, it will be forfeited or subject to repurchase at cost if you leave the company before it has vested. This, unlike ISOs, this can be granted again to employees, directors, consultants. As mentioned, if you purchase the stock and you left before it's vested, it is subject to repurchase by the company at cost, so what you paid for it. So you basically forfeit your right to any future appreciation in those shares. Some companies permit their employees, or more commonly more senior employees, to purchase stock using a promissory note. And the reason they do this is if you purchase the stock for fair market value, there's not any immediate tax impact. And so this can be an effective tool to provide some future tax efficiency. When people purchase or granted restricted stock, they typically file something called an 83B election, which has to do with the tax treatment. I'll touch on a little bit later. You sometimes hear restricted stock also referred to as founder stock, which just basically means it's exactly kind of founder stock that you get when you found a company that is subject to vesting. So the next equity type is RSUs, restricted stock units. Sometimes I hear people confuse them or use the terms interchangeably between restricted stock and RSUs, but they're actually two different equity types. RSUs is the contractual right to receive shares at some point in the future when the award is settled. They feel very similar to restricted stock, except that an RSU is not an award of actual shares. So with restricted stock, at the time of grant, you get actual shares. With an RSU, you don't get actual shares until the future when the award is settled. And in that case, shares are not actually issued until vesting or later. Some companies design RSUs so that the issuance of the shares, and therefore the taxable event, doesn't happen until an IPO or change of control. Some RSUs can also be settled in cash rather than shares, but they're more commonly settled in shares. Less common, but certainly I have seen a fair number of them, are phantom shares or phantom stock. And this is just a right to a cash payment based on the value of company stock. So they don't actually receive shares. They don't receive shares at grant. They don't receive shares at vesting. It really is just a cash payment that is based upon the value of the stock as if they had actually held those shares. It's basically a booking bookkeeping account that increases and decreases over time based upon the appreciation or depreciation. It's subject to vesting the same way that equity is subject to vesting. But again, you don't have any rights as a stockholder. You don't get dividend rights, you don't get voting rights. You never actually have right to the shares. I'm going to touch briefly on profits interest, but again, I don't see this quite as common. A profits interest, again, is only for an LLC entity. So it is an actual equity interest in an LLC, and it only provides for distributions in excess of a certain threshold amount. So it acts very similar to an option in that it's an appreciation award, but it is an actual equity interest. So this is only available for partnerships and LLCs that are taxed as partnerships, but is not available for corporations. I'm not going to go into too much of this. The real downside of a profits interest, or at least as I've experienced it, is the employee is treated as a partner for tax purposes. So when normally you have an employee of a corporation, even if that employee is a stockholder, that employee gets a W-2, the company does withholding, they participate in benefit plans on a pre-tax basis. When they are employees and they are partners for tax purposes, that means that their compensation is not reported on a W-2, it's reported on a K-1. They pay self-employment income tax. They can't participate in certain benefit plans. So there's a real drawback in some senses to have employees receive profits interest and be K-1 partners. So that's why it's a real drawback for some companies for this type of structure. That being said, it's very efficient tax treatment, but it has quite a few downsides, and it still is, I think, a little unfamiliar to a lot of startup companies. And I think, tech VC investors are becoming a little more familiar with it, but it's still not as prevalent as the corporation. Oh man, that was the boring part before. This is going to be the really boring part. First of all, I'm just covering U.S. tax. If I were qualified to speak about tax in another jurisdiction, I'd probably be living there right now. So just some kind of going through some of the basic tax concepts. We talk about compensation income. So those are things like wages. It's also going to apply to equity comp generally. And those are taxed at ordinary income rates. So currently 10 to 37% on a federal level. Then there's another type of income called investment income. So that's what everybody talks about, cap gains rates. And that's currently pretty favorable compared to the federal rates. And that's currently 15 to 20%. There's also something called alternative minimum tax. This is applicable when we start talking about the ISOs, but that's an alternative tax calculation. It's required of certain taxpayers with certain preference items to calculate income taxes. So when I spoke before about restricted stock, I mentioned an 83B election. An 83B election is a notice to the IRS where you elect to be taxed on unvested shares at the time of grant. This relates, I had this question twice today from two different clients. This relates only to unvested shares of stock. So this doesn't relate to when you get a grant of a stock option. This doesn't relate to a grant of RSUs. This is really just when you have unvested shares of stock. Generally, the default is that you're taxed on those shares when they vest at the then current fair market value over whatever you pay for those shares. With an 83B election, you can elect to be taxed on those at the time you receive the shares, which hopefully means it's at a very low value. So you're paying lower tax on those shares. The real trick, and the reason we put this in bold, is the 83B election must be filed within 30 days after grant. The IRS is very clear. There's no ifs, ands, buts. Make sure you have a receipt that you sent it. It's very important that you do the 83B election and file it on time. So the circumstances we most frequently see where it's a no-brainer, grantees should file an 83B if the stock is a very low fair market value on the grant date. So this is your founder stock, right? When you found a company and the stock is worth, a fraction of a penny, you file your 83B election. It starts the capital gains holding period, and then any appreciation in the future is going to be at cap gains rates. You should file an 83B if the low fair market value, especially if you expect the fair market value to increase substantially, which obviously is everybody's hope. And there's a low likelihood that you would forfeit the award. As I mentioned, the advantage is by filing an 83B, you lock in the income tax obligation. So your ordinary, that compensation income, that obligation is over and done with. And then any future appreciation is going to be at cap gains rates. From a company perspective, the company also wants to be aware of the employees who have or have not filed an 83B election, because if they do not file an 83B election, the company will have withholding and reporting obligations as the shares vest. So here's just some couple of quick charts, again, because some of us are visual learners, about sort of the tax consequences at different timing, grant date, we're going to go through grant date, vesting date, sale of shares. So tax consequences at grant date. For an appreciation award, ISO's now calls profits interest, there should generally be no tax consequences at the grant date. There's a bullet here about adverse foreign and any consequences. I'll get to that in a later slide, but generally there shouldn't be any tax consequences for appreciation awards. For full value awards, there can be some tax consequences at grant date, sort of depending on what type of award it is. So for restricted stock and sale, meaning that you actually purchased the shares for fair market value, there is no tax consequence. And in that situation, you'd certainly want to file an 83B. If you get restricted stock and you file an 83B, you will have ordinary income equal to the fair market value on the date of grant. For restricted stock in which you did not file an 83B or for an RSU, there are no tax consequences upon grant. On vesting for an appreciation award, no tax consequences. For a full value award, for restricted stock where you purchased and filed an 83B, or for restricted stock that was granted and filed an 83B, there's no tax consequence because you already had that consequence upon grant. For restricted stock, because you didn't file an 83B, you are going to have fair market value upon vesting. And for an RSU, where, remember, this is the one where you get shares in the future when the RSU vests, if they're settled at the time, you will have ordinary income equal to the fair market value. So tax consequences upon exercise. Obviously, this isn't applicable to your full value awards, but for your appreciation value, your ISOs, the spread is going to be subject to AMT. And for a non-qualified stock option, you're going to have ordinary income equal to the spread value upon exercise. And then the tax consequences upon the subsequent sale. So if you have an appreciation award, so for an ISO and a non-qual, so an ISO, we'll get into a little bit more, assuming you meet the holding period requirements, you're going to have a gain over the exercise price, and that's going to be a cap gains rate. For a non-qual, because you've previously paid ordinary income, the compensation income at the time of exercise, upon the sale, you're going to have cap gains treatment on the appreciation. And for a profits interest, the proceeds are also generally going to be subject to cap gains. And I'm just going, really honestly, tax consequences upon the sale of stock for any of these, because the compensation income event previously occurred, these are all generally going to be at cap gains. So when I mentioned that ISOs have those holding periods, the holding period for ISOs means that after exercise, you have to hold those shares at least 2 years from the grant date and 1 year from the date of exercise in order to meet the holding period requirements and receive the beneficial tax treatment. So assuming you satisfy those holding periods, the gain is taxable at long-term cap gains rates. If you don't meet those holding periods, then the spread upon exercise, or the gain upon sale of less, the spread upon exercise is ordinary income, and then any additional appreciation would be cap gains. I included this little throwaway line at the end of this slide, but generally our experience shows that a lot of people don't exercise and hold their ISAs long enough to actually get that beneficial stock that beneficial tax treatment. They generally don't meet the holding periods. But that being said, I think employees still hear incentive stock option and think it's more favorable. So most companies still continue to grant ISOs to their employees. So I alluded to 409A a little earlier. 409A of the code is certain rules that govern so-called deferred compensation, which generally, just broadly speaking, means compensation that you have an earned and vested right to in one tax year, but it doesn't get paid to you until a future tax year. And the result of not complying with 409A can be pretty steep. So there is an additional 20% excise tax on any deferred compensation that is either not exempt from 409A or not complying with 409A. And when people hear deferred compensation, they sometimes think it's some sort of special, I don't know, retirement plan or something, but it can be a lot broader and pick up severance arrangements or bonuses or equities such as stock options. So it is something we worry about. From a stock option perspective, most companies will try to structure their stock options to be exempt from 409A. And most companies are, but in order to be exempt from 409A, there's a couple requirements. One, and the biggest one, is the options must have an exercise price that's not less than fair market value at the time of grant. So in other words, you can't grant somebody a discount stock option. It needs to be a fair market value stock option. The underlying stock must be service recipient stock. If you're granting options on common stock, you're going to have no problem meeting that requirement. If you make certain changes to the terms of the option after it's granted, that can sometimes blow 409A, so you just want to be careful if you're making any changes. One point I do want to highlight is this really is stock options. If you're granting restricted stock, as I mentioned before, is subject to 83, that A3B election. So restricted stock is not subject to 409A. So you don't need to worry about 409A when you're talking just about restricted stock. As mentioned, violating 409A can be really punitive. It results in immediate taxation at the time it vests, plus an additional 20% tax. And that's not on the company, that's on the individual, so it can be really onerous for the employee. If you grant something called, I know I have the stock options, but if you grant the phantom stock, you must generally require employment at the time of the sale or payment in order to receive payment, so you remain exempt from 409A. There is, as the very first bullet talked about, options have to have an exercise price not less than fair market value. So there's heightened attention on how companies establish fair market value. This is something that gains attention, and anytime you have a financing round, upon any exit scenario, upon an IPO, this is something that companies, the investors or their counsel or your acquirer and their counsel are going to diligence and look at closely. And so a little cottage industry has grown up around how you actually set the fair market value and how you determine the fair market value to set the exercise price. You'll hear a lot, sometimes you'll hear people talk a lot about 409A valuations. Under Section 409A, to determine fair market value, the rules require that the company have a reasonable application of a reasonable valuation method. A valuation method is not reasonable if it's more than 12 months old, meaning you determine the value of the company 2 years ago. It is no longer reasonable for you to rely on that. That valuation must take into account all available information that would be material to the value of the company. And that valuation should not be reasonable if it didn't take into account subsequent events that would be material to the value of the company. 409A provides a safe harbor, and this is what most private companies rely on to grant stock options, is they get a so-called 409A valuation, which is basically just shorthand for an independent appraiser's valuation of the company's stock. And as long as it's less than 12 months old, most companies will rely on that to set the fair market value. There's also securities law considerations. From a federal perspective, there's a federal exemption, Rule 701. It's self-executing, which means there's no filing requirement involved with it. There are certain limits within a 12-month period. You can't grant more than the greater of $1 million, 15% of your assets, or 15% of the class of stock. And the other limit on 701 is it's only available if the grants are to individual service providers. So you can't, for example, grant to an entity consultant under 701. But this is a very broad exemption, and it's pretty flexible, and that's what most companies rely on. You also want to consider blue sky requirements. Those would be, and I just realized I'm going way over, but those are your state securities law requirements. Just very quickly, in an M&A.
Sarah, by the way,
I went way over.
Don't worry. We're actually in a break right now, so we have no one scheduled. So you're good.
Okay, sorry about that. Let me just get back here. And just in terms of M&A considerations, sorry, I'm going here. Oh, I screwed up. This is why I shouldn't do things. Treatment of equity awards in a change of control, just briefly, there's a broad range of treatments that can happen in a change of control. We talked a little bit before about sort of single trigger, double trigger acceleration. But just broadly, you can have an acquirer take on the equity. The equity could be canceled, it could be cashed out. There's just a number of things. They could be converted to a cash award that pays out over time. There could be accelerated vesting. It's usually, most companies their equity plan will be structured to have a menu of alternatives that occur in an M&A scenario, and then it's usually a matter of negotiation with the acquirer. So again, sometimes an acquirer will, when an option conversion rollover, the acquirer is going to take on your equity awards. Usually the terms and conditions will remain the same, and then there will just be a ratio applied to the option to convert it into the buyer stock. And that ratio will make sure to preserve the aggregate spread value in the option. I was going to just touch on this briefly, but awards can be canceled, and you can either cancel them for no consideration, depending on the plan, or it could be canceled in exchange for a cash payment, either to be paid at the time of the acquisition or to be paid out upon the later vesting. The latter and the first three are all kind of variations of that. The latter one, providing that someone would exercise in connection with an M&A, that's less common, but you occasionally can require somebody to exercise as a requirement in order to participate in the M&A. And now, since I went way over, I can open it up to questions.
Yeah, audience, if you have any specific questions for Sarah, thank you. That was I thought it was a great overview, Sarah, and I think one of the questions I had, while reading through this and having worked for a couple startups, like having experience with profits interest, like it can be a bit confusing. Like I had a specific question around like when you hear profits interest, and I think when you do like your initial research, you read like, okay, so the company has to be profitable in order for me to get my appropriate share at the end of a fiscal year, right? But you were talking about more of it working like restricted stock. Can you just clarify like exactly how that functions comparatively?
Yeah, so profits interest, again, it's an actual interest in the LLC. It has to, in order to get that profits interest treatment where it's not taxable on grant, it needs to only share above a certain threshold. And so it's some LLC interest can be granted with what's called a catch-up feature. It means that if you have a profits interest holder, they will, once you get to that threshold, they'll start to share disproportionately in distributions until they quote unquote catch up to where everybody else was. And so I think where LLC or profits interest can sometimes be tricky with startup companies or employees are, as I mentioned, they have to be K1 from like a compensation perspective. And just, as a partner, they share in the profits and loss of the company. And, for some, especially for more rank and file employees, it can be a little bit of a shock to the system or a different, tax result than what they're normally used to.
Right. So Jackson asks, why wouldn't someone exercise an 83B?
So why wouldn't somebody file an 83B? Where I don't see people in a private let me put it this way, in a private company context, it would be very rare that someone would not file an 83B. Where somebody wouldn't do it is if they weren't prepared to pay the tax, or they the shares are subject to a performance condition, where it was subject to an exit at a certain valuation where there wasn't certainty that it would vest. They might not want to prepay tax on something if they're not certain it'll vest. More common in the public company context, people don't file 83Bs because public company stock, you've already kind of had your big appreciation event up to before you become a public company. Unless if you're a public company, the stock price can go up and down a little bit more. And so again, you might not want to prepay tax when, it might lose value.
Yeah, I had a colleague once who actually, he was granted profits interest and considered not filing the 83B, which essentially means he didn't accept the profits interest. Is that correct?
Yeah, some profits interests are set up that a condition to receiving the profits interest, you file an 83B. For a profits interest, an 83B is considered a protective election. So to have profits interest treatment, like I said, it has to have that threshold value. Another requirement, there's a safe harbor, is that you hold the interest for at least 2 years. And so there's some, if, for example, you were concerned that you might not meet the 2-year holding period, so it might not be respected as a profits interest, you might file the 83B to make sure that you still could take the position it was granted to you at a low value.
Right.
Otherwise, for profits interest, I would almost always do an 83B.
Yep. Got it. Great. And Jackson also asked, are you willing to share the PowerPoint with the group?
Sure.
Awesome.
Yep.
Great info in there. Well, Sarah, thank you so much. This was an excellent, very thorough overview of equity compensation at startups. So appreciate your thought leadership here, and thank you for your time.
No problem.